Good morning. The year in review. So at the end of each calendar year, our good friend from SIBO, Henry Schwartz, posts his options analysis for that prior year. Today in the workshop, we will have a look at the highlights after the bell. Howdy, partner.
Lex,
that is so ridiculous.
Lex, if you were to be a cowboy, you realize you have to get near the cows, right?
Yeah, no, that's the horses, cows. They're not for me. No, thanks. How are you, Jason?
I'm doing okay. How are you doing, Lex?
Good. Everything's good. No Mark today. He's visiting Mr. Doctor, I suppose. But we're here. So what we decided to do today is take a look at the year in review from SIBO. And Henry Schwartz is the data master, the flow master that he's been called. He's got his hands and mind wrapped around all the option metrics over the past year. And he's so tight with all the data. It's so good. So having said that, he put out a deck for all of us, and we're going to kind of run through the deck and kind of highlight the highlights, right? Anything you want to add to that, Jason? What do you think?
No, I mean, of course he's tight with the data. He's right there at the exchange, right?
yeah, he sees it all. So
yep.
Okay, let's go through it and see what we come up with, right? We'll show the deck here. We'll kind of breeze through it and see how we do.
Yeah, it is pretty long, so I mean, we're not going to be able to fit everything in here.
Yeah,
so
we're just gonna.
Yeah, I encourage everybody to go to the SIBO website and download this themselves if they're interested in this, these kind of wonky, option stuff. But these were the highlights, this and the next slide. Some of these talking mainly about option volumes exploding. I don't know. What do you think, Lex? This is 41 days, top 70 million contracts.
Yeah. Let me just make a comment here because just for reference, in the prior year, 2024, the industry did around 10.4 billion contracts. 2025, you can see that in the first line. It did 15.2 billion contracts. That is a massive increase. And average daily volume went from, I want to say it was in the 45 million per day in 2024 to 2025 topping, 60 million per day. That's some unbelievable numbers.
Yeah. And, the other thing too about it, index options averaged 5 million, SPX is 3.9. So even though there was plus 26 year over year, this is also this wasn't a zero DTE thing only. And it also wasn't an index thing only. That happened across all single stocks. You see right here, single stock went plus 28, ETFs plus 32 right here. I mean, that's a lot. 10 times the level traded in 2019. Yeah,
no, I agree. These are some significant numbers. And the other milestone that he has on this is Miami trading floor opened. So that's a physical trading floor opened in Miami by MyX, I believe. IEX will launch in 2026. And what does that mean? He's revenue counted 19 with 7 operators. Yeah. So we are currently at 20-ish, I think, exchanges, which means that exchanges have outpaced the number of actual market makers in the system. So technically, and I don't know the exact number of market makers left, but I want to say it's around 12, give or take, right? And exchanges are 20. Pretty crazy, right?
Yeah. Well, I mean, I guess at least the top 10 are, 90% of the volume or something ridiculous, right? I mean, I'm sure there's little market makers here and there, but the Citadels and Jane Street and Susquehanna, they handle a lot of that volume.
Yep, for sure. And then I like the little. Oh, sorry. I was going to say I like the little little snippet about the regulatory tailwinds, which is progress on easing PDT rules, which is my hot bucket item. I forgot he had this in here, but that PDT, pattern day trading, just is that you have to have 25,000 or more in your account in order to open and close within that given rolling 5-day period. Blah blah blah.
Mm-hmm.
That is not going away, I don't think. Unfortunately, I wish it would. But it is being eased. So that number may go all the way down to like $2,000. That's the number I'm hearing, but who knows? Maybe we get a full deal here. So
one thing I did want to point out, I mean, in all of the studies that we do at Volland, more volume does not mean less stability. It actually is the opposite. More volume means more liquidity and therefore more stability in the options market. I see way too many hot takes talking about how much gamma is out there or how much premiums, total premium, at this OPEX is some record, which is like, some billion, which is not net, by the way. And I look at stuff like that and I'm like, do not believe that. I mean, this amount of contracts, number one, they wouldn't be traded this heavily if it wasn't stable.
Yep.
And number two, this actually, the liquidity increases stability. So that's I guess my little soapbox too.
No, that's fine. Okay, next, no, that's good. I like it. Next slide. What do we got here? This is
just a heat map of volume, with green being more volume and red being the least. Mm-hmm. And I don't know if you remember, but 2020 during COVID, that's when everybody said, "Oh, the options market is, going off the rails. Too many options," and it was only the beginning. Look at this.
Yeah,
look at that.
Yeah. So there's our numbers. If you look at the total column, which is like the third-ish one down, fourth one that says total, reading across. Look how this has grown from 2020, 29, mm-hmm. 38, 40, 43. I said 45, but it's actually 47, nearly 48 last year, and now we're at just about 60 and a half, 61. In 2025. And I think, just seeing how the year's going so far, I mean, look, it hasn't eased up at all. I think volume is still pretty solid, right?
Yeah. I think also another thing to note is calls. There are more calls traded than puts traded. Mm-hmm. That's something that we notice, like in Volland, obviously we see all the calls and there's a lot more covered calls, I guess. But people kind of tend to think like, oh, puts are being traded. That means, bearish, that kind of thing.
Yep.
Well, there's more calls traded than puts, and it's varying, like here was 2 million difference.
Yep.
And that, I guess, in 2022, that was like a down year, right? Like we kind of had a trend down year. So mm-hmm. This might be something to think about, something to study. Might write that down.
Yeah, write that down for yourself.
Is the difference between calls and puts something to study? All right.
Next slide.
This is just a tabular. This looks like just a tabular view of what we just saw.
Yeah. So this is the graphical view, you mean?
Yeah.
And tabular, I guess.
No, okay. I'm sorry. Yeah. Well, I was looking at this, but yeah, this is the graphical view of what we just saw.
Okay.
Skip it.
Skip it.
This is the same kind of thing. Average daily volume being 60.8 million, and they
mm-hmm.
split it into calls and puts. Stock, flex, ETF. That's another thing to think about is how flex is going to start to impact. Mm-hmm. It's still kind of small compared to the rest, but it's not a small number.
While we're on flex, let's just define what flex is because there's, folks might not understand what that means. Some of the beginners. So how would you describe a flex?
So flex option is one in which you can determine the strike price, the expiration, and that's it, right? Strike price and expiration, and they tell you how much the premium will be.
Yeah, so they'll give you a market. So you can't ask for the terms of the contract. Meaning you can't say, "Oh, I want it to settle in 50 shares versus 100."
Right.
You're not allowed to do that, at least yet. But it's those two components: the expiration date, right,
and time,
and time, right? Exactly.
So you could go like
and strike. Sorry, and strike. You can make up funny strikes. Sorry,
but it could be like these penny strikes within little bits of time. 15 minutes even. It's I think hopefully the Robinhood traders don't get wind of that. Like what will my price be for thing 5 minutes from now?
Yeah, well, that's coming with event space anyhow. So we'll talk about it on another show. All right.
Yeah.
Volume by product type. So we've got ETF, and they broke it down by the top 10, which is the most interesting. Index top 10, and then single stock. This is kind of cool too. Let's start with ETF. What do you see?
Well, ETF obviously is dominated by QQQ and SPY. But when you look at some of these other things, the QQQ one to me is the one that's most notable. Because QQQ is 20% of the ETF, which is very substantial. If we look up here, ETFs are this blue line, so it's substantial. But there's no NDX. Why would that be, Lex?
My friends at NASDAQ aren't going to like this, but one of the problem with NASDAQ, NDX, it used to be a great trader back in the day. However, it's a very large product, right? And notional. That's number one. Shouldn't really matter too much. Number two, the liquidity's gone bye-bye. And I mean, when I mean liquidity, it is like some of these markets are like you could drive a semi through them. And for a retail person, and you retail folks who are listening, you got to stay away from things that you can't get in and out of easily. That's all there is to it. I hate to say that, or maybe I'm happy to say it, but you need liquidity. That's the point of the matter when you're trading on a screen. And that's two of the reasons I think that NDX is really, really struggling. Do you have any other thoughts on that? Is the same kind of stuff?
We know why the liquidity is not there. It's because there's only one market maker allowed to make a market on it.
Yeah.
And so if you're the only game in town, there's no reason to compete on your own pricing. So
right. Why would you? Agreed. So that's ETFs, and I'm looking at some of these TLTs in there. That's a good one. SLV, which is a silver. GLD's in there. Good to see that. Gold. Some of these inverses look like are in here too, or doubles and triples, whatever. Interesting. Now, let's skip index for now. Let's go to single stock on the right.
Yeah.
Look at 67%.
Well, that's just because it's combining 2,237 others.
I thought that was like Tesla and Apple together.
No, Apple's right here at 3%.
Okay.
Tesla is over here at 8%.
Where's Tesla? Okay, got it. I missed that. Why is Tesla green? Okay.
Tesla's over here at 8%. Nvidia is 10%, which is notable in itself.
Yeah, those are big numbers.
Yeah, those are huge. Tesla Nvidia is like a newcomer on the massive block scene.
It made my watch list. Nvidia. So did Palantir. So both of those made it, and they're busy.
Well, Palantir is here at 2%, but yeah, I mean, even the 2% of this amount of options is a lot. But this also shows a lot of dispersion in the market. I mean, you got the top two, and then there's just a ton of dispersion. So
for sure. All right, let's go to the middle. I mean, I don't know if this is obvious.
We already talked about this is a little bit. We already talked about this.
Oh no, you missed the middle, the index. Go back.
Oh, we want to talk about index. Okay.
Yeah, real quick. So SPX 77%. What is that one?
SPX.
Okay. Crazy, right? It's a $7,000 product, which is cool, right? Pretty good size notional. Look at XSP, which is the 10th share of that. Very small. And look at it's coming along. It really is. And SIBO is working hard on bringing liquidity to that product, which is great. And it's my case all the time. Listen, you got to bring that liquidity first. Retail people will love to trade a product that's $700 as opposed to $7,000, right?
Yeah.
What's beautiful about this index space for retail people? A lot of European style options, so no early exercise and a lot of cash settled. Beautiful. Right?
Favorable tax.
Yeah, sorry, I forgot about that. The 60/40 tax treatment is another great one. So great things there. Okay. Let's move along here.
All right. This we've talked about kind of already. This is more about time to expiry. So this is like zero DTE kind of stuff.
Yeah, this is a big deal though, right? If you look at it.
But we are seeing growth in all expiries, right? Like 25.1 million.
Yep.
But zero DTE is, I think part of this is just, the fine tuning also between market makers and, people redistributing risk. So
yeah, I agree. Fair enough.
But the other thing too about zero DTE trades is, especially now that SPY and QQQ are 0 DTE, and now we're getting, some individual stocks, retail traders in particular are being called up and being forced to close them out. Otherwise they get exercised or something like that. And they don't want that. So, I mean, that's kind of and that counts in the volume while the exercises do not.
Right. 100%. Okay. Volume. This is where you like this one. So you explain this because I didn't understand what you were saying at first. I didn't think about it hard yet, but let's hear it.
So this green line is average daily option volume, right?
Okay.
And this is compound returns, right? Compound annualized growth.
Okay.
This is the volume in the underlyings itself. Okay. So it's the growth in the spot, right?
Okay, so hold on. The green is average daily option volume.
Yep.
And then the darker color blue, average daily spot volume, the underline itself.
Yes.
Okay.
And what this shows me is how much option volume has an impact on the spot price and volume itself. So, if you, like obviously dealers are going to have at least a little bit of an imbalance, and they're going to be hedging using the underlying. So underlying volume is skyrocketing at a similar, maybe just slightly less, but at a similar pace as the option volume, which to me kind of validates the thing I've been saying for a long time is dealer positioning matters, right? Like it matters in the overall market, and one would argue the overall economy. So, so I mean, these option dynamics are actually driving part of our economy, right? The people who are invested,
right?
So I just, I find that fascinating myself.
No, I agree with it too. I think that's a good analysis. Okay, good. What's next? Volume index. What is this now?
So this is daily option volume in the index products. We kind of talked about it above. There's just some of the smaller ones down here that we didn't call out.
Right. Same with the next one. We know this top index products. We got that.
It's premium. It says it's basically this, but in premium terms.
Okay. This is
this is interesting.
Yeah, global trading hours. So without seeing this, I'm guessing it's not a massive number. It's single digits. Oh, it is. Okay. But it is growing, which is interesting. I'm not sure why though. I guess we're going around the globe and we have 24-hour trading around the globe. Maybe has some weight on it. Who knows? I don't trade after hours.
Well,
I don't
over here, the kind of the crux of this chart to me is what happens at 3:10 a.m. or really 3 o'clock to 3:10 a.m. In Eastern. I guess this is Eastern time, or is it?
I would imagine,
Central or Eastern. But this is when Europe opens.
Yeah.
What this is telling me is that Asia doesn't really trade the options so much. Perhaps the growth has happened in Europe. And then we're over here, you're getting like the pre-market American traders. And, and they kind of shut off the index, right? Like they shut it off like kind of right here. But, here is like America and Europe. But when Europe seems to be ramping up their American exposure. So
Sure. Okay. What do you think about this one? Average execution size.
So that to me means people are trading a lot fewer per trade, which we've noticed, and that kind of points to, maybe it is retail.
That's what I think.
Oh yeah, it could be retail but it kind of flatlines right here, like at 2020, like right at COVID, we kind of hit a flat line. I do think also part of it is when you have a floor, all the hedge funds and Goldman Sachs and whatever just puts in this massive order, but they're getting better execution quality when they break down those large trades into small pieces. Yeah. So I think that might have something to do with it too, because obviously the number of trades have increased if the volume has increased like that.
Yep.
But I see it a lot too when I see like in within a 30-second time frame, there is 25, 25, 25, 25, all the same option or all the same structure. And it's just like 25 lots and a ton of them in a row. So I think that's kind of how that's kind of how like funds and institutions are trading. But
okay, got it. Open interest is next. Yeah.
This actually matters because this kind of isolates out any 0 DTE, and it shows, that there is growth in longer term rather than just 0 DTE options in itself.
Right. Single stock is the top one, right? The big green one?
Yeah, single stock. The single stock growth is,
which makes sense to me because people own stocks. They might be selling longer dated stuff or buying longer dated stuff against it, collars and what have you. So that actually makes sense to me.
Yeah, it just seems like the index is the one that's like the smallest, but I think
makes sense too, right?
Yeah,
as you said. Okay.
Well, just there's not as many products.
Yeah.
Single
stock.
A
lot of near-term trading in that too that just expires. So
yeah, right. Implied versus realized volatility. So they're kind of showing the COVID crash year, the yen carry, and then Liberation Day, which I think Henry goes a little bit more into it later on. Yeah, I think though that once after 2020, and we're not seeing much before this, but here we had like Volmageddon and a 15% drop, right?
Mm-hmm.
As we got more liquid, we've had very few events, right? Like sometimes we over VIX or whatever, little vol events, but other than Liberation Day, which was kind of at least the feeling of a threat to the economy, options have gotten more stable, I think.
Right. Got it. What slide is that?
So this is skew. This is Henry's assessment of the skew. And he put his little trade alert item numbers in there.
Okay.
But yeah, I mean, and I kind of saw this as a little bit speculative, but he sees like people selling out of the money calls. This here, and remember calls there were more calls traded than puts since 2020 at least. So he sees like a lot of people buying puts up into here. Yeah. This I think is a little bit. I think there are sellers now, especially in 0 DTE. There are a lot of premium sellers right in this area right here.
Yeah. Mm-hmm. Let's. You know what? I know we're running up on time. If you skip down to 0 DTE, which is like slide 35.
Okay.
Go to there. Let's get that before we have to run.
Okay.
27.
35. A lot of this stuff is like order type, stuff like that.
Yeah, I mean, might not be as interesting to the retail folks. This is where
here we go. Tradier dynamics.
Okay, so what do we got here? Let's talk about this because this is so popular right now.
Mm-hmm. So these are just 0 DTE single stock.
Yep.
And they have 0 DTEs every Friday, right? So I think that's what he's counting here. The ETFs though have 0 DTEs all the time, and so does SPX here, which but ETFs have QQQ and SPY. I think this just might be by virtue of more offerings.
Sure. Okay. Fact versus fiction, 0 DTE options. Fiction. Oh, fact. I got it.
Yeah.
Anything noteworthy here? I don't think.
He
puts pose large systemic risk. That's the fiction part.
That's what SIBO has been pushing that forever because there's kind of been some, I guess you could say, bad Twitter press on 0 DTEs that it would cause a lot more systemic risk. And I agree with Henry on this one. The more liquidity you have, the less systemic risk you have. So
right. Yep. And the next slide is SPX 0 DTE. Okay.
Yeah.
So average volume versus execution size. This is interesting because, right? Why? It looks like the average execution size is probably smaller, but volume has grown. So that is indicative of the retail folks jumping in.
Yeah.
And Henry told me when I was on the SIBO floor with him a while back that 99% of 0 DT executions occur electronically. Which means, because don't forget, SPX is still an open outcry pit, sort of, which means that is heavy retail, right? A one-lot trader is not picking up a phone and calling a broker. He's hitting his machine. Right. So 99%.
Also, I think machines give better quotes too because they give quicker quotes.
Yep.
And I don't know how many open outcry. I mean, you could tell me, but how many open outcry people trust their speed against a 0 DTE option?
Yeah, I mean, well, look at the open outcry people are really human bodies stuck in a computer, if you will, right? That's all it is. So
right, but they have to say something. There has to be some communication, and by then,
yeah,
because
SPX, it does happen. I've been there. I've seen it. I've seen the yelling and screaming. It doesn't happen, as much as it does on the screen, but it happens. So yes, true.
Yeah, I'm not saying it doesn't happen. I'm just I kind of think that computers have the speed to quote things quicker than human mouth would, right?
Yep. Okay. What is next here?
Oh, option volume by maturity. So this kind of just talking about how 0 DTE volume has skyrocketed.
Yeah.
But 0 DTE, truthfully, before dailies were offered, every Friday that 0 DTE would explode in volume too.
Sure.
So I mean, I think it might be just like the way the risk is managed and how I guess people or institutions trade it,
Yep, for sure. You have duration. Go to the participant analysis. So this is interesting too, I think. So he's got market maker, customer, pro customer, firm, broker, dealer.
Mm-hmm. Well, customers are retail or small lot people.
Yeah, that's the 2.3 million, right?
Mm-hmm. Yeah.
And then pro customer, that's a little different.
Pro customer are people who have 390 orders in a day, right? The 390 rule.
Yep.
Firm are people that OCC, it's the 100 OCC firms that are like regulated, and I guess broker dealer are just the platforms themselves trying to provide liquidity where it isn't really available. So, but this is saying that retail customers and market makers are the trading partners, right?
Yeah, right. What do we got on this next one? This is strategies. Net sold, net bought
versus sold options.
I don't know what that one is. We're gonna have to ask Henry on that one.
0 DT. Oh, so he's saying outright means single leg option trades, right?
Oh, gotcha. Okay.
And these are opening versus closing. So a lot of people are opening bought options here, and they are they're not buying to close very often. And only on the 0 DTE. And then here, these are sold to close. So there's a lot of people doing single leg buying options. And I guess, is this SPX? Yeah, it's just SPX. Right. So single leg buying an option, call or put, and then selling it maybe really quickly.
Got it. And then the next slide is going to be complex orders, vertical
spreads, stuff like that. This is interesting because these are bought to close and sold to open. So there's a lot of people selling spreads, but there are also, a lot of people buying individual options. One thing we were talking about, you and Mark like to use that automated bot that, does the condors. You would be falling into these blue areas.
Yep.
And then, and then when you reach your target, you're falling into these green areas.
Right.
Right. Each of these are, 8K is actually 16K options, right? Because vertical spread is 2 legs. You're still being outnumbered by the people who are single legging it, right? Oops.
Yeah, for sure.
So, I mean, I think it's increased a little bit, it seems, but it seems like right here in the beginning of the day, that's when it happens.
Right. Very cool. Okay.
And then he's talking about straddle.
You might want to pick one more slide here. I think we gotta wrap it up here.
Let's pick this one because we talk a lot on this show about how straddle prices are the market maker expectation.
Yep.
So all these straddles are getting blown away.
What does that mean? Tell me what that means.
So if these are negative, it looks like the green is is this axis, right? Straddle purchase results, and this is the straddle price. The straddle price is generally kind of, it looks like the average is about 40.
Yep.
But it looks like since the Trump tariff time, straddles have dramatically underperformed the market. Very rarely have they peaked above. Maybe, I guess, a little bit here in October.
Yeah.
But straddle prices look like they are priced to lose. So if
Priced to lose. So you mean if you're buying them, they're priced to lose?
Yeah.
Okay.
If you're buying them, they're priced to lose. Do not buy calls and puts. So, all right. I think that's our time.
All right. Good. That was good. Always interesting with Henry and the data that they produce there. It's fascinating stuff. Probably for retail people, they're like, oh, whoopee doo, kind of cool, but show me the money kind of thing. But it's nice to know that the business is really growing. It's I like to say democratized, meaning everyone has access. It's just you have a few shekels, you put them in your account, and you can start trading for the most part. And I don't mean to say that in a negative way, that you should do that. You should absolutely understand what you're doing with options. They can be complex, but you can also make them very simple, what you do. So we'll talk about that as we move along in the show. Any plugs, Jason? Tell them where they can find you.
We got Volland with it. It's mirrored or something like that. We got Volland, who shows you your option dealer positioning.
Okay. Vol.land, right?
Vol.land.
Vol.land. I love it. And then, incidentally, I'm starting to push this out here. We Tradier are working on the first live summit that we will host and sponsor with SIBO, actually. And hopefully a guy like Henry will be there to present. But that's going to be in early May. We're looking at May 7th and 8th in Palm Beach, Florida. Mark your calendars. There's information coming out soon. We're trying to get through the final preparation. You will get an email if you're a subscriber to hub.tradier.com, among other places. Make sure you look out for that. It'll be a really fun time. You'll get to meet all of us in person, plus a number of other folks presenting and talking and having cocktail hour and what have you. So stay tuned for that. All right. That's it, I think, right?
That's it.
Happy trading. Happy trading. Have a great week, everybody.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.